All right, good afternoon, everyone. Thank you so much for joining us. I'm Lisa Partida with Home Again LA. And please excuse the fact that I don't have my camera on. I hope it doesn't really matter, but yeah, my camera is not working. And we have Tom today with Bank of Hope, and today's topic will be building your financial future. So without further ado, I'll pass it along to Tom.
Thanks, Lisa. And I'll say I'm sorry I do have my camera on today because like before we started the recording, I was saying I have some allergies going on. So excuse my sniffles. Hopefully it won't impede our process of going through the workshop. But anyway, this is building your financial future. This is actually a really short topic. There's a couple of sections at the end we're not going to cover because they're like super specific. They cover student loans and some other things. But our the key things that we're going to talk about is asset building and wealth building. So for our first section, we're going to talk about assets and asset building. We're going to define key terms. We're going to talk about what assets are, why assets are beneficial, how assets can help build your financial future, and how you can develop a plan to build those assets. So the key takeaway from our first sections is that assets can lead to wealth and financial security. But before we even get into it, we got to make define our terms, right? So let's talk about what an asset is. So an asset is something that you own that has a value. For something to be an asset, you must own it, be able to control it, and be able to make decisions about it. For assets that are not money, you must be able to exchange them for money. So as we talk about different kind of assets, kind of think to yourself, what are some kind of things that normally you wouldn't consider an asset? One of the things I talk about in this workshop from the past is that I collect baseball cards. Baseball cards can be considered an asset. One, they retain a value. And not only do they retain a value, but I'm able to actually sell them to get money out of them, right? So that could be like a alternative form of like a physical asset. People consider gold a physical asset, but there's other things. People have hobbies and they may collect things that have value. And those things again will fall into the physical assets bucket, right? But there's other kind of assets too, like financial assets, right? What is that? Financial assets are cash, money in your checking account, money in your savings account. Maybe you own stocks, maybe you own bonds, things like that. Some assets are intangible and they're called protective assets. They're not physical or financial. They help you produce more assets by earning more money. An example of this would be like investing in your education or a training program that can help you build your skills in your current job, or maybe a certificate program that can help you get a different job. So skills themselves can be classified as a productive asset. Credit reports and scores can also be productive assets because they can help you get other assets that require financing. An asset's value is determined based upon the type of asset. So physical assets are valued upon their resale value. Remember, I told you about the baseball card thing? I mean, I could make a totally bad decision and invest in a player that's not very good, that won't have good resale value. Another example could be purchasing a house. Some people consider a house as an asset. I don't know if I would disagree with that, however. Um, what about in times of economic downturn like the 2008 financial crisis? Did people consider their homes assets then? They rock bottom and they ended up not being worth as much as they were when they were purchased 5, 10, 20 years prior. Um, what about a car as an asset? A car not only can be a physical asset, but it can be a productive asset because the car holds value in itself, but it also gets you to your college because you're going to school for a career, or it gets you to your job that where you get your paycheck, things like that. Um, Financial assets therefore have an actual value. Think about the amount of money that you have in your savings or your checking account. There's a dollar amount uh, assigned to that, right? So there's value in that. And then productive assets offer benefits that generally are not reflected on the bottom line, like in dollars. However, it can help you accrue more dollars in the future. Okay. Now there are sections in the participant guide called triads, and these are meant to be done after the workshop. But let me just kind of set you up with what you're going to see afterwards. So in this section of the participant guide, we have, well, what is an asset? Now, this is going to be, we don't have the full page of what you're going to see, right? So there's a lot more items that are listed. Let me tell you what you're going to see in the participant guide. And what you're going to do is you're going to go from left to right and identifying, is this an asset or is it not? There's also a section that it depends, and then some notes for you to jot down depending on what the asset is. Here's some of the assets that you're going to see: a new computer, a credit card, a college degree. By the way, the other thing I would mention as far as notes from the discussion, you can actually put in there what type of asset it is, whether it be physical, financial, or productive as well, because that kind of fits the criteria as well. Um, Inventory in a business, your credit history and credit score, lunch at a restaurant, renting an apartment, on the job training, money in a savings account, a cell phone, a house that you own, um, things like that. There's a couple more, but that gives you an idea um, of completing that exercise. So it's yes, no, it depends, and then notes for you. And remember, I talked about the physical, financial, and productive aspect of it. This is where we're going to put those in. So for this specifically, though, you're going to think about your actual assets. So this is going to be specific to each individual because we all have different physical, financial, and productive assets in our lives. But what you're going to do is that you're going to fill this out based upon the physical assets that you have, the financial assets that you have, and then those productive assets that you have. Um, so, for instance, for myself, a physical asset that I would have would be maybe my house. A financial asset that I have maybe would be my 401k. And then a productive asset that I have. Oh, that's a tough one. What would be a productive asset that I have? I may have to put my car. No, I wouldn't put my car in there. So that's a tough one. Um, I may have to think about it and come back to it. Um, or maybe that indicates that I actually need to find something else to do so I could fill that bucket, right? Anyhow, let's talk about benefits of asset building now. Okay. So now that we've defined our terms, let's actually talk about how we're going to do it. So, asset building refers to strategies that increase the financial, physical, and productive assets that you own. The strategies may increase the value of assets that you already have or help you acquire new ones. Being financially secure means you can take care of yourself and your family even if the unexpected happens. Okay. So financial security requires both income and assets. Job losses, an accident or illness, the breakdown of your car, or needing to take an extended time off of work are examples of potentially unexpected events that may require you to have money set aside. Assets provide a financial cushion to help you manage those unexpected events. You can think of your assets as the foundation for building that financial future. Assets are essential to achieving long-term financial stability and growing your wealth over time. Um, so essentially, owning assets creates that buffer, if you will, the buffer to help you and your family handle emergencies and hardships as they come. A reduction in hours at your work or a job loss can be one. A major illness, a broken furnace can result in unexpected expenses. Assets can help you make it through those periods of financial need. Um, Owning assets also helps you reach your goals. It's easier to further your education, buy a house, have income in retirement, or start a business when you have assets. Owning assets increases your options as well. Assets provide you with options, more choices for education, for healthcare, for where you live, for the size of your television, for example, and a lot of other things uh, that come up in life. Owning assets helps you earn more income and succeed in the job market. Owning a physical asset like a car can increase your income and job prospects because maybe a higher paying job is far across town, 40 miles away. Um, owning a car can allow you to take that journey, and maybe sidestep the need to rely on something like public transit, for example. Productive assets like education and skills can help you also earn more income by learning a new skill, either to increase your knowledge for the job that you have or to get a new job altogether in a different career field or a different career path. Owning assets inspires you to look to the future and make long-term plans. Having assets and a plan to build more assets can encourage you to actually first want to make goals, but then also try to achieve those goals. Thinking about the future can help you be motivated to plan for it. Owning assets reduces stress for you and your family. Households with at least $2,000 in assets can easily be converted into cash, are less likely to forego things like doctor visits, uh, may help you um, avoid missing late payments on utility bills, for example. Um, those kind of things, right? Families who have assets feel less stress over financial issues. One of the main stressors that we have in our lives, unfortunately, comes down to money. Knowing you have assets to fall back on can allow you a little bit of peace of mind. Many people pass their assets down to their family members too, knowing that you have a cushion um, to pass down to your children, for example, uh, can be motivating and encouraging, right? And we also have apply it sections in the participant guide for the purposes of the workshop. Go ahead and fill that section out after the workshop. But essentially on this apply it, we have developing my plan to build more assets. And I'll give you a little snippet of what this is going to look like. Um, Having a strategy to build assets in all three areas is important. And remember, we talked about it: financial, physical, and productive. And the reason that we want to have these three is we want to be really diversified and thinking of having a diversified portfolio of assets that can allow us to build the proper foundation for financial security. So the activity is going to help you develop a plan for assets. And it's going to ask you a series of questions. So these are the questions that you're going to be posed with when you're filling this section out of the apply it. Okay. So what additional assets would help me meet my goals? What resources do I need to get those assets? What specific steps could I take to get those resources? What are some obstacles that may get in the way from me building that asset? And then how will I manage those obstacles? So your strategy is very personal to you, which is why we're going to do this as kind of like a homework thing. Um, so for example, um, let's say, um, so if part of your plan is to buy a house, think about the assets that will help you get that house. What would that be? Well, it would be a good credit score and a healthy a healthy credit report. What would another thing be to achieve that goal of having a house as an asset? How about making sure that you've saved enough for that down payment? And then a plan for getting those assets as well would also help in fleshing that out a little bit more. But anyway, those are the questions that you will be posed with whatever asset you decide um, to choose. And then you're going to fill that out in those categories of financial, physical, and productive. And you're going to answer those questions. Okay. Excuse me. So that is the ending of section one. And in section one, our key takeaway is assets can lead to wealth and financial security. But remember, we were talking about that idea of strategy and planning, right? And if we are building out those three key criteria, that's going to lay the foundation, right? So what I want to talk about next in section 2 is how assets create a financial foundation. And what we're going to do in this section is we're going to define net worth and explain how it relates to financial security and the ability to meet your financial goals, an example of calculating it, and then identifying strategies to changing net worth. All right. So in section 2, we have net worth is a good measure of your financial stability. Calculate your net worth by subtracting your liabilities, and liabilities are money that you owe others, from your assets. All right, so let's talk about assets, liabilities, and equity. So to understand how assets create wealth, you need to understand how assets are related to liability and equity. An asset is something that you own that has value. We already talked about that, right? To get assets, you sometimes need to borrow money. For example, to buy a house or to go to college, most people have to take a loan out. A liability is something that you owe others, usually in the form of money. Once you borrow money, you have a liability until you pay that money back in full. Many assets, especially financial assets, do not create a liability. You don't have to borrow money to, for example, build a savings account, set aside money for goals, create an emergency fund, contribute to a retirement account, save in an educational fund, um, things like that. Assets and liabilities are also related to equity. Equity is the value of an asset minus the liability related to that asset. It's part of the asset that you own outright. In this next try it for section 2, we have calculating liability and equity. And in this scenario, we have a scenario with Ezra. So Ezra is going to be making a car purchase. And we're going to fill this out after the workshop, but I kind of want to set you up. Ezra needs a car to get to work and to school. He finds a used car at a dealership that's worth $5,000. He has been saving $25 a week for the past 6 months. He now has $600 to use as a down payment. So you can't see the whole. I don't think we have the whole thing. No. So please check it out in the participant guide after the workshop. But let me verbally kind of go through and explain what we're going to see here. Okay. So question 1 that we ask ourselves is, what is the car's value? Right. And remember, we said the car's value is $5,000. Ezra decides to take out a loan to buy the car. So how much money does he need to borrow? So remember, he has $600 for that down payment, right? So if he's buying a car for $5,000, that means that the total amount of loan that he needs to get is $4,400. So what is Ezra's liability for the car? And remember, a liability is what you owe. So the answer in that is that 4,400, because that's the amount that Ezra's borrowing from the bank. So what is Ezra's equity in the car once he drives it off the lot? So equity equals the value of the asset minus the liability related to that asset, remember? So the answer would be, we have 5,000, which is the car's purchase, minus the loan he took out for 4,400, and that equals essentially what his down payment was. So essentially, Ezra's equity in his car purchase is that $600 that he put down. So that's a good way of understanding how to calculate liability and equity. But please check out that section in the tried and the participant guide, and then you can see the full scenario that I kind of verbally described, okay? So let's move on, and we're going to talk about net worth. So net worth is a measure of someone's financial wealth. Net worth is your assets minus your liabilities. It is what you have left over after you pay off your liabilities. So another way to think about of your net worth, it's the equity from all of your assets added together. So your net worth So your net worth can be a positive, it could be a zero, or it could be a negative number. A positive net worth means that the value of your assets covers more or all of your liabilities, and there is still some left over. This means you have a cushion for financial emergencies, essentially. So, and it's good to have a positive net worth. Zero net worth means that your assets equal your liabilities. You do not have a financial cushion, essentially. A negative net worth means that your liabilities are greater than your assets. So no financial cushion in this scenario. Um, uh, so income alone is not enough to determine if someone has economic security when we think about how we're actually having net worth. That income could be disrupted again by uh, a loss of a job or an illness, for example. Plus, you can't tell from income how much debt someone has. An example could be someone could make a high income like $250,000 a year. I mean, that looks great, right? On paper, but in nowhere does that tell us in that scenario if that person spends a lot or spends more than the money that they bring in. So just as easily as you can make $250,000, that person could just as easily spend $350,000 because they have a lifestyle that they're trying to maintain and they're overspending the amount of money that they're bringing in. I think this calculation that we have here in the net worth is a better indicator of your financial health. So it doesn't just boil down to how much money you're bringing in, because again, we don't know how much debt someone has, especially calculated debt over a long period of time. So just remember, just because someone makes a lot of money doesn't mean that they're wealthy at all. It just means that they make a lot of money and they have a high paying job. That's all it really means. Um, in this next try it section, in the participant guide, what we have is another scenario, and this is scenarios with Justine calculating her net worth. Again, we only have a little snippet here, but let me try to set you up with what you'll see after the workshop. So Justine bought her home 7 years ago. The current value of her home is $130,000, and she still owes $100,000 on her mortgage. She has 1,500 in a checking account and 500 in a savings account, which she uses for emergencies. She has a truck that she bought used a few years ago. She could sell it for 2,000. She still owes 3,000 on the loan for the truck. She has one credit card with a balance of 1,000, and it has a student loan with a balance of 15,000. She has a lot of furniture and heirlooms handed down from her grandmother, including some genuine antiques, and their values recent estimated to be $7,000. So essentially, what you're going to do is you're going to take all of the financial information that we have for Justine here, and you're going to calculate her net worth. I don't, do we have her? Yeah, we do have it here. So essentially what we're going to do is we're going to extract, and you're going to see in the participant guide an assets table. You're going to see a liabilities table, okay? And then you're going to see the ultimate net worth calculation that we get. Let me set you up by understanding this in the assets column. Remember, we have the things here that we said. She has $2,000 in a savings account. Her truck is valued at 2,000. She owns her home worth 130,000. She has 7,000 worth of antiques from her grandmother. And then we can see here on the top of the table, that means that as far as the asset table is concerned, it has a combined value of 141,000, right? Let's talk about that liabilities table as we extract it from here, right? Her credit card, she owes 1,000. Remember, she owes 100,000 on her mortgage still. She has a vehicle loan on that truck for 3,000. Her student loan's 15,000. So that gives us a total out of all of that on the asset excuse me, on the liabilities table of 119,000. So remember how we calculate the net worth, right? Net worth, total assets minus total liabilities. So the answer in this scenario is a positive 22,000. So Justine's net worth is a positive 22,000. And then in this apply it section, um, um, you're going to fill out the table below to calculate your net worth to the best of your abilities. You can leave blank any rows that don't apply to you. We don't have the full table here, but this is going to be specific to you. So just like we were talking about Justine in calculating her net worth, you're going to do the exact same thing for your scenario, okay? There's going to be an assets table, a liabilities table. You're going to fill those out, and then you're going to be able to calculate your net worth. Okay? Now that we've defined our key terms and we kind of understand this a little bit more, let's talk about increasing your net worth. So changing your net worth. You can increase your net worth by increasing your assets or by decreasing your liabilities or by doing both. Excuse me. Sorry. Ways to increase. Yeah. So you could spend less than you make. Sounds simple, but it's tough. There are so many pressures that make you want to spend. You could be on shopping on the internet and you get all those advertisements on things that uh, purchases that are specific to you because of cookies and things like that. One of the things that we always bring up in these workshops is whenever I go to Burlington, Ross, or Five Below, and you have all the items that you were there to shop for, but now you have to snake through the queue to get to the register to pay, and they have all those impulse buys. Um, the there's so many things that make you want to spend money, right? So super tough to do. Buy less than you can afford. When buying homes, cars, furniture, computers, or whatever, buy less than you can afford. Provides flexibility and prevents you from becoming overstretched financially. Save money. Building savings is building an asset. Save for an emergency fund, save for your goals. Saving even a small amount of money on a regular basis can make a long difference because money compounds over time. The greatest thing that you have at your disposal is not just the interest rate that you're getting on your savings account or whatever it is, it's the time. Time is the most important factor for compounding your money and building wealth over time. Okay. Participate in a retirement savings program. I have a 401k at work, and luckily enough, my employer matches my uh, contributions up to a certain percentage. Pretty cool. Use debt responsibly. Remember, if you take a credit card out, you're creating a liability. So don't go swipe happy spending as much money as you possibly can. You want to use that responsibly. Okay. Um, Pay down your debts. Um, Paying down your debts decreases the amount of liabilities, so your liabilities go down. Okay. Um, Claim the appropriate tax benefits when it comes to, or tax credits when you're filing your tax return. Another way to save money on the tax return as well is taking part of programs like VITA through the US government. VITA is the Volunteer Income Tax Assistance Program. It's income driven. I can't remember what the dollar amount was for this year, so forgive me, but you can look it up. Just go to the IRS's website. Anyway, but you can get your tax return done for free below a certain income limit. And those folks are completely trained tax professionals that can help you claim the appropriate tax credits that you're due. Shop around. Doesn't matter what it is. Cross compare against different products that you're deciding that you're going to purchase. You can also do this if you're going to take out a credit card, open a checking account, buy stocks. I don't care. compare two things against each other to make sure that you're getting the best value for it. And then we have and apply it in the participant guide. Uh, this is an exercise in increasing your net worth. You can use this exercise after today's training to identify ways to increase your net worth by increasing your assets and reducing your liabilities. So that's going to be super specific um, to what you have going on in your own life. But anyway, check that out, and it could be super useful. I don't want to go into the last couple sections, so we're going to wrap up what we're covering today. Um, and the reason is because the last two sections are super specific. It's about student loans specifically and car loans specifically. They're too specific for us to really talk about, I think. Anyway, so the section two in our last section is net worth is a good measure of your financial stability. Calculate your net worth by subtracting your liabilities, money you owe others from your assets. And remember, I think the key takeaway in this section is have you ever heard that saying, comparison is the thief of joy? We can see, especially now with social media, other people's lives live out online, and it's so easy to compare yourself to others these days. Don't do that. Why is net worth a better indicator of your financial health compared to the amount of money that you make at your job? Someone could make $200,000 a year. They could be completely irresponsible with their money. They could have 500,000 in debt with a negative net worth of 300,000. You could be making $50,000 a year. You could be living financially responsibly, and you could have money set aside in a 401k, a little bit of money set aside in an emergency fund, a little bit of money in savings. And when it comes down to subtracting that against your liabilities, you might actually have a positive net worth compared to someone who makes 150,000 more a year than you. And you could have a better financial foundation just because of that measure. Okay. Anyway, I would love to hear if we have any questions related to this or anything I might be helpful with. Do we have any questions before we wrap up? And I'll stop sharing right now. I know we have a few things in the chat. Let's see what we've got here. Thank you for dropping the participant guide in there. I see. Very
Mm-hmm.
good.
And then in regards to the impulsive buying, I put TikTok Shop because I know that's my nemesis right now.
Oh yeah, I don't even know what
Uh,
that is. You can
oh
buy
no.
stuff on there?
You can buy stuff off of TikTok. I've been my thing has been makeup lately.
Oh, I had no
So
idea.
like
Okay.
yeah, you're just scrolling and then they have like ads for like different stuff, so that's how they get you. I mean anywhere, even like you said, Marshalls, TJ
Yeah,
Maxx and all those other stores. But no, I think that was just my comment there. But
I
if
had no
anybody
idea.
has any questions, feel free to. Well, that's what happens on the weekend when you're just like scrolling on your phone. Even
Oh yeah,
Instagram will
for
get
sure.
you. Yeah, so
Yeah.
ads are everywhere. But I guess if no one has any questions, I guess we'll just end it here. Thank you so much, Tom, and everybody for being here today. If you guys have any questions, feel free to email me if you'd like. If you have any questions, but you should be able to download it off the chat. All right, so I guess we'll catch you guys next month. And Tom, I hope you feel better.
Oh, thank you. Thanks, Lisa.
All
Good to see
right.
you. And then we'll see everyone next month.
All righty. Bye.
All right. Bye, y'all.